The volatility index recently shot up to its highest level in years, and CNN's Fear Greed Index is now indicating that the market is in extreme fear. The last time we had a major recession was in 2008. Many dividend-paying stocks never fully recovered, and even some of these companies that have done well over the past decade are still not paying out as much in dividends since the 2008 recession. For example, Bank of America stock is up over 130% in the last decade, but their quarterly dividend payment is still not as high as it was before the 2008 recession. So this presents the question, how do we build a retirement dividend portfolio that is recession-proof? In this video, we'll be building out an example of a recession-proof dividend portfolio. In order to successfully do this, there are some key qualities that the stocks you buy must have. And in my opinion, one of the key metrics we should look for when building a recession-proof dividend portfolio is low volatility. Now, how can we know if a stock has low volatility? Well, this is where the measurement beta comes into play. Beta is a measure of volatility of a security compared to the market as a whole, and typically we compare it to the S&P 500. Now let's look at a quick example. Let's say we want to plug in Coca-Cola right here as an example, stock ticker KO. Using the ticker data function, we can easily see Coca-Cola's beta by clicking Coca-Cola and clicking beta and hitting enter. And what we can see is Coca-Cola has a beta of 0.59. Now, what does this even mean? Well, we have to keep in mind when we talk about beta, we're measuring it against the S&P 500, and the S&P 500 has a beta of 1.0. So this means that Coca-Cola is much less volatile than the S&P 500. Now, if the beta was above 1, that means it's more volatile than the S&P 500. Again, we're looking for low volatility. So the stocks we have in this portfolio, we want them to be below 1. Again, if we jump over to Seeking Alpha, we can see S&P 500 over the past year is up around 19.57%. Now, we can see some fluctuations throughout this year, but overall it's up. Now, a stock with lower volatility is going to have less fluctuations. It might not go up as much as the market, but it also won't go down as much as the market. Again, that's something we want out of a recession-proof dividend portfolio. Now, the next criteria we want to look for when building a recession-proof dividend portfolio is making sure that the stocks that we buy, the underlying fundamentals, remained unchanged during previous downtrends. Now, the key word here is underlying fundamentals. What do I mean by this? Well, if we jump back over to Seeking Alpha, let's look at an example. We'll plug in UNH. And we can see, if we zoom out 5 years, we can see right here, during COVID, there's a drop in the share price for this company. They were trading as high as about $300 per share and dropped all the way down to almost $200 per share. So that was a massive 33% decline in the share price. But when we talk about recession-proof, we're not talking about the share price. We're talking about the underlying fundamentals remaining unchanged. So for example, if we jump over to my stock screener, come up here and plug in UNH and hit enter. And all this data will automatically load in. Now, like always, if you're wondering how all this data is automatically loading into my spreadsheet, or you'd like to be able to download any of the spreadsheets you see in this video, then you can head over to tickerdata.com at the link in the description. You can see here the Ticker Data add-on in Google Sheets allows me to automatically import stock financials straight into my spreadsheet. Now, back to what we were talking about, UNH. Yes, the share price did drop during 2020, but look at the underlying fundamentals. We can see revenue per share in 2019 at $252, and in 2020, it jumped up to $269. So yes, although during the market decline, we did see UNH share price drop, the underlying fundamentals got even better. Look at earnings per share. We saw a jump up there in 2020 as well. The same is true with free cash flow per share. So when we talk about underlying fundamentals remaining unchanged, we don't necessarily mean that the share price never goes down, but we mean metrics like revenue coming in, net income, earnings per share, and dividends being paid out are continuing to grow during market downturns. Now, the next criteria is fairly simple. We want to know that the companies we buy are expected to grow their earnings per share in the future. Growing earnings per share is what drives intrinsic value over the long term, and it allows them to reward shareholders with things like share buybacks and paying out dividends. So we don't want to buy any companies that don't have the ability to grow their earnings per share over time. And then finally, we want to have confidence that the company can grow their dividend payments year after year and that they have a history of increasing those dividend payments, ideally above the rate of inflation. Because if a company isn't increasing their dividend payouts at a rate above inflation, then they're technically not increasing their dividend payments at all. So let's start building out our portfolio and looking at examples of stocks that meet all 4 of these criteria. And the first stock that we'll look at is going to be Costco, stock ticker COST. And we can see all this data will automatically load in. Now, the first thing we'll point out is the beta for Costco is currently sitting at 0.679. So again, the volatility should be less than that of the market. Yes, this company has a very low starting dividend yield, as we'll talk about here in a minute, but the payout ratio is also very low, but we can see they're growing dividends at a very rapid rate. The total amount they grew their dividend payments from 2018 to 2023 was 43%, and we can see earnings per share growing at a very fast rate at 11.7%. So we've checked off a couple of boxes. We can see, yes, low volatility. The earnings per share has historically been growing, and we can check to see if it'll continue to grow. We can see the dividends have continued to grow as well, but have the underlying fundamentals remained unchanged during previous downtrends? Well, let's jump over to our stock screener. We'll come up here and plug in COST. And again, thanks to ticker data, this data will load in. Now, what we can see is over the past decade, and especially during 2020, revenue per share was continuing to grow every single year. The same is true with earnings per share, free cash flow per share. So the underlying fundamentals remained very strong. If we jump over to the profitability and income statement sheet and plug in Costco, if we come over here, we can see that blue bar chart here. Revenue was increasing every single year, even in 2020. And something else that is very important is the company was able to maintain its gross profit ratios during 2020 as well. If we jump over to my dividend breakdown sheet, we can plug in Costco. And what we'll see is, like I mentioned earlier, yes, low dividend yield, but the dividend has been growing at a very high rate. We can see multiple times throughout the past decade, they paid out special dividends on multiple occasions. And we can also see the free cash flow is easily covering those dividend payments. In 2023, they generated over $6.7 billion in free cash flow, while dividends paid out was sitting at about $1.25 billion. And when we talk about Costco, from a business model standpoint, their revenues are growing every single year because of the beautiful business model. Much of it is subscription based. Subscription revenue is growing every year, and they have very little churn. The company is constantly growing their membership income, and we can see they also have a very high worldwide membership renewal rate. So because of all these qualities, Costco makes for a pretty good stock to have for a recession-proof dividend portfolio. Now, the next company we're going to look at will be stock ticker KO, and that stands for Coca-Cola Company. What we can see about this company is they have a very low beta, sitting at 0.59. So again, low levels of volatility. They pay out a bit more in dividends, around 2.85%. Payout ratio is a little high at about 74.22%, but we can see they are growing those dividend payments over time, and they're growing their earnings per share over time as well. If we go ahead and jump over to the dividend breakdown sheet, we'll come up here and plug in KO. And what we can see is, yes, dividend yield sitting at 2.85% like I mentioned, but a great history of increasing those dividends every single year. And keep in mind, this company is a dividend king with over 50 consecutive years of dividend increases. That 10-year dividend CAGR is sitting at about 4.75%, and we can see their free cash flow. Keep in mind, dividends are paid out of free cash flow, and their free cash flow is covering those dividend payments pretty easily, especially since 2019. For example, in 2020, free cash flow is about $8.6 billion, and dividends paid out sitting at about $7 billion, and free cash flow has continued to grow over the past 5 or so years. And again, the beautiful thing about Coca-Cola is the business model and how strong the brand is. The company's been around for many decades. It doesn't matter if you're 80 years old or 10 years old, you know about Coca-Cola's products. And they've been able to withstand a lot of difficult times during the lifetime of this company. Now, the next company is one you're probably not familiar with, and I've actually never talked about it on the channel before. You may have heard of them, but it's stock ticker CHD. And again, if I come over here and drag this formula down, we'll be able to see the metrics. We can see this company has a beta sitting at 0.52, so again, even lower levels of volatility than Coca-Cola. The dividend yield is low, sitting at about 1.13%, but the payout ratio is low as well. They're growing those dividend payments, and the earnings are growing at a pretty healthy rate as well. Now, if you aren't familiar with this company, it's Church & Dwight Company, and if we scroll down, we can see this company is in the consumer staples sector, and the industry is household products. So a lot of the times, these types of companies don't hurt nearly as much during years like 2020. And if we jump over to the stock screener, we can see an example of this. And I think you'll like what you're gonna see. Revenue per share consistently growing over the past decade. So again, even during difficult times, revenue has been growing. The same is true with earnings per share and free cash flow per share. And we can also see this company has been buying back shares over the past decade, with shares outstanding in 2013 being around 277 million and declining all the way to around 244 million. So not a lot of share buybacks, but they are buying back shares. If we look at them from a dividend perspective, one of the things I like the most about this company is how easily their free cash flow has been growing and covering those dividend payments. So yes, those dividend payments have been growing every single year for the past decade, but their payout ratios have remained very low, sitting at about 35%, and free cash flow payout ratio around 33%. So they're generating plenty of free cash flow to pay out dividends, to grow those dividends, but also reinvest back into the business, in turn growing their earnings per share year over year. Now, the next stock on this list is one that's a little more controversial, and a lot of people don't like the business model, and that's going to be stock ticker MO Altria Group. This is a company that's been around for over 100 years, and we can see the beta sitting at about 0.69, and they have a very high starting dividend yield. Right now, it's sitting at about 7.79%, but what I do want to point out is if we talk about that dividend yield for Altria Group, come over to Seeking Alpha, look at the dividend yield and scroll down, we can see if we zoom out over the past 10 years, there have been points in times where that dividend yield has been starting at over 10%, and for much of the past year, it was high as around 9.5%, so something to keep in mind. Now what we can also see is the payout ratio is a little high, sitting at about 83.38%, which typically is a concern for me, but not in the case of Altria, and let me tell you why. Management is specifically targeting a payout ratio for this company of around 80%. They've looked at their free cash flow and analyzed their investor base and has decided that their best way to reward their shareholders is in the form of dividends. And I'll show you why this dividend is more safe than you think in just a moment. But if we look at the total 5-year dividend growth, yes, they are growing dividends, which is pretty impressive for a high yield, and the earnings have continued to grow as well. So if we go ahead and jump over to our dividend breakdown sheet, come up here and plug in MO. Again, we can see things that I've already mentioned: high starting dividend yield, great history of dividend growth. This company is a dividend king with over 50 consecutive years of growing dividends. But again, the free cash flow is covering those dividend payments. So yes, the payout ratio is high, but this is on purpose. Management has specifically stated they are targeting an 80% free cash flow payout ratio. We can see in 2023 free cash flow at over $9 billion and dividends paid out about $6.77 billion. So again, free cash flow is covering those dividend payments. If we jump over to our stock screener and plug in MO, what we can see is revenue per share has slowly but steadily continued to increase. Now, earnings per share is a little bit choppy, but if we look at the company's free cash flow per share, again, slowly but steadily increasing. We can also see they are buying back shares. Debt to assets is in a decently healthy range, and return on invested capital for this company is surprisingly very, very good. In 2023, this was sitting at 39.27%, which is very, very impressive. Now, the last thing I want to mention about this company, again, the business model. People who buy products from Altria typically buy them for a lifetime. Now, one of the potential problems with Altria is they have a lot of regulatory risk, so that is something to keep in mind, but Altria is making moves to make their products more healthy so they will be sustainable long term. Now, the next company on our list is one that I own in my portfolio, and it's actually one that I'm up pretty big on, and that is WM Waste Management. And the thought process behind this one is pretty simple. As we'll see, yes, they do meet all 4 of our criteria, but the business model is not going away anytime soon, especially during recessions. We can see low beta, dividend yield is around 1.5%, healthy payout ratio, and the earnings and dividends have been growing at a very healthy rate of about 7%. We'll jump over to our stock screener and plug in WM. And like you would expect, all the metrics have continued to grow over the past decade. Revenue per share looks good, and the same is true with EPS and free cash flow per share. Slight decline in 2020, but overall they came back even stronger, so it's not really something I'm concerned about. Again, when we talk about the business model, the trash truck is pretty much going to come every single week, regardless of what's going on in the economy. If we look at the dividend metrics, we can see that these dividends are safe and they're growing and very sustainable. So I can feel pretty confident this company is going to be around for a very long time. And overall, the success of this company is not necessarily correlated with the growth of the market. That's a good thing for a recession-proof portfolio. Now, the next company on this list is actually one that didn't just stay steady during 2020, but they grew their earnings significantly during that time, and that is Johnson & Johnson. This company has the lowest beta we've seen yet, sitting at about 0.51, so very low levels of volatility, decent starting dividend yield, low payout ratio, and they've continued to grow their dividends over the past 5 years, and earnings per share has grown pretty significantly as well. If we just simply look at Johnson & Johnson here on Seeking Alpha, let's look at the past 5 years. They're up around 21%, which isn't a huge amount, but here's what else you have to understand. If we jump over to financials and just simply look at the income statement, look at what's happened with revenue over the past decade. We can see completely unfazed. For the most part, they're seeing growth pretty much every single year, and especially on the bottom lines. If we jump over to net income, we can see it grew significantly over the past few years. So healthcare stocks are typically considered pretty solid options when it comes to recessions. And I think Johnson & Johnson definitely falls into that category. Let's talk about another healthcare stock. Now this one's a little bit different, and that's UNH, and that stands for United Health Group. Let's go ahead and drag this down. Now this is a stock I actually added to my portfolio over the past year, and I'm really excited about holding it because I love what I've seen from them over the past decade and their ability to grow earnings per share in the future. We can see beta sitting at 0.6, dividend yield is sitting at 1.5, payout ratio is low, but here's what I really love. The dividend growth and earnings per share growth over the past decade on average has been very high for this company. In fact, let's go ahead and jump over to the stock screener, come up here and plug in UNH. We can see over the past decade, top lines and bottom lines for this company have absolutely exploded. Look how much growth there's been. Revenue per share has gone from $121 all the way up to $400 in 2023. Earnings per share growth has been pretty unbelievable, and the same is true with free cash flow per share. Let's go ahead and look at the profitability sheet. We'll come up here again, UNH. And what we can see is double-digit revenue growth over the past 5 and 10 years. The same is true with net income. These charts are quite literally a thing of beauty. And again, one of the other key things I like to look for is not having changes in the gross profit ratio. And here's what's really interesting about this company. We can see the 10-year average gross profit ratio is sitting at 23.92%. But look at what happened in 2020. They actually saw a spike up. It went all the way up to 25.62%. So not only did it stay the same during a market downtrend, it got even better. If we look at the company from a dividend perspective, what we can see is unbelievably rapid dividend growth over the past decade. Nearly 20% 10-year dividend compounded annual growth rate, and the 5-year is sitting at 15.2. So their dividend payments in 2013 was sitting at $1.05, and in 2023 it jumped all the way up to $7.29 and is now sitting at $8.40. That's very impressive, and we can see this has all been backed by growing free cash flow. 2023 free cash flow sitting at $25.6 billion, while dividends paid out was sitting at $6.7 billion. This is absolutely beautiful. So UNH, one of the most impressive stocks over the past decade in my opinion. Now what's interesting about Lockheed Martin is most of the company's revenue is coming from government contracts. For example, we can see half of the corporation's annual sales are to the US Department of Defense. Lockheed Martin is also a contractor for the US Department of Energy and the National Aeronautics and Space Administration, NASA. Now, I don't know how much you know about the government, but let me tell you this, they are not afraid to spend your tax money. And I can prove it. If we jump over to the stock screener, let's come over here and plug in LMT. What we'll see is this is a company that in 2023 brought in over $67.5 billion, and revenue is continuing to increase, and 2020 was actually a pretty big jump up. We can see 2019 revenue at $59.8 billion, and then in 2020, $65.4 billion. If we look at our stock screener, we'll see there's quite a few things to like about this company. Like I've already pointed out, top and bottom line growth has looked pretty good over the past decade, but they've also bought back quite a few shares, going from around 321 million all the way down to around 250 million in 2023. Now, quick little share buyback lesson, you have to understand, if a company is buying back its shares, it's going to boost all of its per share metrics. So buying back shares helps boost earnings per share, revenue per share, free cash flow per share, and actually even helps them pay out even more in dividends. We can see the company has a healthy debt to assets ratio, and return on invested capital looks good. Again, remember, return on invested capital, this is telling us how profitable are the projects that the company is investing into. So an ROIC of almost 30% is really good. Their projects are very profitable. If we look at my dividend breakdown, what we can see is very stable levels of dividend growth. The 10-year dividend CAGR is pretty solid at about 8.66%, and the growth looks really good over the past decade, starting dividend yield of about 2.26%, and free cash flow has been covering those dividend payments. And then the next company on this list is going to be stock ticker PG, and that stands for Procter & Gamble. Again, this company meets all of our criteria: low volatility, pays out a dividend, and a somewhat decently healthy dividend that is growing, and earnings per share growth has been low, but it has been growing, which will increase its intrinsic value over time. If we look at this company on my stock screener, what we'll see is the growth hasn't necessarily been very high, but it has been very stable with not a lot of fluctuations or not a lot of volatility in reality. If we look at earnings per share, we can see 2019 was a rough year for the company, but they actually stormed back in 2020, and it grew pretty significantly during that time and has continued to grow over the past 3 or 4 years. And if we look at the company from a dividend perspective, and we can see a steady history of increasing those dividend payments and free cash flow covering those dividend payments, and the payout ratio has remained in a relatively decent range. So far we have 9 companies on our list of an example recession-proof dividend portfolio, and so far the average beta sitting at about 58.78, the average yield sitting at 2.56% with payout ratio of around 48%, and the dividend growth looks very good so far at about 10%. The average 10-year earnings per share growth looks good at 8.29%. So the last stock, or should I say ETF, that I want to add is going to be one that you know if you've watched my channel before, because it's one I view pretty positively for quite a few different reasons, and that's the Dividend Growth ETF, SCHD. Now, because this is a dividend ETF, it's not going to have a few traditional metrics that stocks would have, like the payout ratio or earnings per share, because again, this is an ETF, not a company. But what we can see is a nice starting dividend yield, the beta sitting at 0.77, and a very impressive 5-year dividend growth rate of almost 11%. If we go over to Seeking Alpha, again, link in the description to Seeking Alpha. So if we jump over and look at Seeking Alpha and click on the dividends metric, and look at the dividend history again, you'll see the dividend payments do fluctuate because this is a dividend growth ETF, but overall, we can see those dividend payments have continued to grow every single year. If we zoom up and look at the dividend growth rates, we can see pretty good history on a yearly basis of increasing those dividend payments, and they've really increased quite a bit since 2018. If we look at the holdings breakdown, we can see this is fairly well diversified. But one of the things you do have to keep in mind when you buy a dividend ETF is make sure there's not a lot of overlap with your current holdings. Maybe that's something you're comfortable with, but it is something you need to be aware of. And for example, we can see Lockheed Martin is the largest holding in SCHD, but that's actually a company that was already on our list, so that is something you have to understand and be aware of. But overall, this is a pretty well diversified dividend growth ETF with around 103 total holdings. The stocks that it holds in its portfolio are companies that continue to grow their earnings and free cash flow per share, in turn driving up their intrinsic value and driving how much they can pay out in dividends, which benefits SCHD greatly. So now that we have our 10 examples, we can see average beta at about 61, average yield around 2.66, and average payout ratio around 48%. The dividend growth looks really good at around 10% and earnings per share growth at about 8.3%. And while this is just an example portfolio, the most important thing you can take away from this is making sure that a portfolio that you build that you want to be recession proof follows these key metrics right here, the 4 key criteria. And like I mentioned earlier, one of the things we have to remember, recession proof doesn't mean that the share price never goes down. What it means is that the underlying fundamentals remain strong during those downtrends. And the beautiful thing about a recession-proof dividend portfolio is regardless of what's going on in the market, these companies continue to grow their earnings per share, in turn paying you out more in dividends every single year. So while a recession-proof dividend portfolio might not be a group of the most exciting stocks in the world, it definitely gets the job done. Now, like always, if you'd like to be able to automatically import stock financials straight into your spreadsheet and also get access to any of the spreadsheets that you see in this video, then you can head over to tickerdata.com at the link in the description. Now, go ahead and let me know what you think are other examples of recession-proof stocks down in the comments down below. And like always, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.